Good evening, everyone. I want to thank you so much for joining this session titled Maximizing Your Investment Potential Through Risk-Adjusted Tax Advantage Multifamily Real Estate. My name is Dami Fadikbe. We will get into proper introductions later on. This morning, I was just thinking, and one thing occurred to me. So the human being is at an all-time low as far as attention. So you being here tonight really means a lot to me, and having to listen to what I have to say, having to listen to my story. It's one thing to be interested in business. It's one thing to actually be interested in the person, because business can never be successful if you don't even like the person that you're getting into business with. So it's especially real estate. Real estate is a relationship-based business. And every day of my life now, I try to build relationship with individuals. Let them know who the person is. Let them know where I'm coming from. Also, let them know why I'm doing this. So I really appreciate you for taking the time out to be here tonight. It really means a lot to me. Hopefully, this will be the start of great things to come. So a little bit about myself. I am Damilola Fadikbe, and I am the managing partner of a company called Westworth Capital. Again, we help individuals maximize their tax returns through multifamily real estate. And multifamily real estate is a field that is really interesting once you start to get into it. There's a lot of money to be made. There's a lot of mistakes to be made. So actually leveraging relationships, leveraging people, and ensuring that you do not do everything all by yourself. That is one sure way to be successful. Now, one sure way to fail is doing it all on your own, right? So no one is the island of knowledge. No one knows it all. So it's really important to have subject matter expertise and everything on your team. So I am the managing partner. I do have another co-founder here with me today. My other partners couldn't make it. We're in the middle of a deal, so we're kickstarting due diligence. When it gets to a time like this, there was a lot of back and forth. So anyway, I want to talk about my journey into multifamily real estate. See, I worked for different companies in corporate America. I've worked for Fulton Financial Corporation. I've worked for BNP Paribas and JP Morgan Chase most recently. And in those roles, I led teams, I managed projects, and I saw how day to day we worked for entrepreneurs, right? So we worked day and night for people that are actually making the money, and then we get a tiny percentage by way of our income. So I started to think, there's got to be a way out. I wasn't enjoying it. I learned a lot from it. And the people that I met, the relationships that I built all through the years has led me to this point, right? All of a sudden, I just thought there had to be a way out. And, and Josh right there that you see right there, we used to work at JP Morgan together. We were in the same office, right? And it was since then, we always talked about, hey, we will just start doing something else. And we were both into real estate right from the start. We were both into real estate. We were always looking at deals, always looking at how do we add value to real estate. And so that brought us here to where we are at this point. And another speaker that I have on here with me is Mark Perlberg. Mark is the founder of Perlberg CPA PLLC. He is specialized in advanced tax reduction strategies, CPA, tax certified coach. He's a certified tax planner. He has a master's in accounting from North Carolina State University. You will be hearing from Mark as the meeting goes on. So while we're here today, what is the purpose of us being here today? And keep in mind, guys, we have a chat box. If you have questions, you can put in your questions in the chat box. But earlier we called for questions. We will try to, some people already submitted questions, but we will try to get to the questions that are submitted in the chat box if time permits us. What is multifamily syndication? Well, it's a really not difficult to understand concept, right? It's really easy. First of all, there are a group of people in commercial real estate, right? And there's an investor or an operator or a syndicator. And an investor may find a great deal but lack the capital to make it happen. On the other side, many passive investors, they want a return on their investments, but they lack the time and or expertise even to execute a real estate deal. So that's how real estate syndication was born. The idea, the model, the business model of someone being a syndicator and working together with someone that has the money and doesn't have the time to execute deals. So syndicators identify, analyze, and negotiate great deals. There are a lot of great deals out there. There are a lot of bad deals out there. So it's the work of the syndicator to identify the great deal. And syndicators are also known as the sponsors. They find the deal, they underwrite the deal. You know, as part of the underwriting process is the syndicator identifies there's a gap. That is the difference between the cash required and the cash that the syndicator plans on personally contributing to the deal. So it's a structure. There's a legal structure behind syndications. Syndications are exempt to SEC requirements, but they are required to register the exemption, legal requirements there. So the syndicator acquires large-scale properties. These are multifamily properties, and it could be any other property under the commercial real estate, right? And they manage the asset, they add value to the asset, distribute returns to the investors. So, like I said, commercial real estate includes a wide variety of property types. You can have industrial, self-storage, office, retail, and each of these categories include its own unique challenges. So real estate syndicators, in essence, they generally focus on a single property type because it's really difficult to master all the asset classes that we have out there. So I've had this question pop up in my conversations with investors in the past, like, so what do you do? I can assure you guys, it's definitely not this. We do not take the money and go party with the money. It doesn't happen. And essentially what we do is we find and underwrite the deals, right? And we spend a lot of our time looking for analyzing potential deals and finding deals that likely include reviewing, okay, what's going to be the return on this deal if we put this deal under contract. And there are different ways that we look for the deals. It could be on the market, right? We could find the deals on the market, or due to extensive relationships that we have built with brokers, right? Some brokers will bring deals to us so that we can analyze and see, okay, what are the returns going to look like before they go on the market. Every deal will eventually, if they don't get signed, if they don't go on the contract, will go on the market, because who are you for an investor to keep a deal, under the wraps and not show it to anybody else? At the end of the day, money is the name of the game. But due to good relationship, we at Westworth Capital, we also get to take a look at some really great deals and try to put them on the contract before I actually go on the market. So some deals would never actually see the light of the market. We snap those up as soon as we can. Another thing is pre-acquisition due diligence. As a syndicator, one of the jobs that we do is the pre-acquisition due diligence. So after we put the property under contract, then we go into the due diligence phase. And once we can confirm that the deal numbers, the numbers of the deal make sense, conceptually, the goal is to identify problems. So you want to see, okay, what's the surprise here? Is there anything that was in the original offering memorandum prepared by the broker that we've come to find out? So that might be a basis for going back, negotiating the price of the deal. So once that is done, then we begin to raise equity funds from you people, from equity investors. Ideally, you want to work with a syndicator that has his own skin in the game, that has money in the deal. Because if I have my money in the deal, I will take care of the deal. I will work hard for the deal to be successful. One thing to ask a syndicator when you are investing in a deal: do you have your own money in the deal? How much of your money goes in the deal? And then we go on to secure the debt financing. This is by obtaining loans from financial institutions, from the banks, the credit unions, and we complete the acquisition for the syndication. And now that's when the real work starts. Pre-acquisition, some work, but post-acquisition is really when a lot of the work start for us. So upon acquiring the assets, then we move on to the day-to-day operations of the property, right? So generally, we manage the leasing, the maintenance, the rent collections, the unit turns. So one tenant moves out, you want to make sure that there are no gaps before you actually admit the next tenant into the unit. And because that ultimately affects the revenue. And we do this by having contracts with the experts, right? Because managing a property is a different ballgame. So third management property company, we engage them all the time. So we do not manage any of our properties at all. We believe the experts should handle that. And even at that, right, even when there's a property management company handling the asset, day-to-day operation, the syndicator still maintains the ultimate responsibility for the property's performance, for better or worse. If the property goes down south, it's never going to be the property management fault because we hired the property management company. So everything still comes back to the operator. So the next point of what a syndication does, or a syndicator does, is the sell the property. So that's what we call the exit. And that's when the investors actually get the bulk of their money back. So we manage the exit process, that is, put the property back on the market for sale. Every investment that you invest, every money that you put into our investments, there's an exit. There's a point at which you expect to get your money back with returns, hopefully double the returns. So that's the exit. So we manage the exit process. We actually package the property. We write the offering memorandum in conjunction with the broker. And then upon the sale of the assets, we distribute the remaining funds and handle the final accounting and tax work. There's a little bit of tax work that goes on there upon the sale of the assets, right? So proper tax planning is really important. And that's why I have Mark on here to talk about that. Another thing that we do is investor relations. So throughout the entire process, we as syndicators must actually manage communications with the investors. Proper communication, transparency ensures that whatever is happening reaches the investor on time, and they're well aware of what's going on, either good or bad. We at Westworth Capital, we believe in over-communicating. We do not wait for the investor to find out what's going on. So generally, investor updates happen monthly, and many times when we have good news to share or even bad news to share, our investors hear from us through email all the time, right? Just last week, one of our properties in Dallas, we were just discussing after the asset management meeting. That property is actually outperforming what we had projected, right? We hadn't even gone halfway through our post-renovation revenues, and we're already beating it. That's one of the things that we do as syndicators. So what are the benefits? What are the benefits of investing in multifamily real estate syndication? Well, number one is the stability. Multifamily properties provide consistent valuations and consistent demand. For example, 100 units apartment building doesn't experience a dramatic dip in revenue when one tenant or even two move out. So you have a 100-unit building, one tenant moves out, two tenants move out, or even three tenants. There's the stability in the revenue stream. And that is as against a single family home or even a fourplex, right? So a fourplex, one person moves out, that's already 75% occupancy, right? You're not even going to get an agency debt with that, right? With a 75% occupancy, talking multifamily wise, right? So, and unlike stocks, gold, or Bitcoin, people need a place to live. So multifamily actually provides a basic necessity of man, right? Meaning they're always in demand. Someone told me that to be in business, or if you like to be in business for a long time, you need to focus on two things. And those are the two basic needs of the humanity. Number one is the food, and number two is housing. So if you can provide any of that and you do it well, you're going to be in business for a long time. I like to be in business for a long time, and that's why I've chosen multifamily. The number two is the control. So when market fluctuations happen, we have the ability to make operational changes, immediately reduce our expenses and limit the vacancies and ensure that our assets continue to perform. If there is a, say, recession, lack of jobs, we can immediately make operational changes. Hey, if we were providing internet before, we will no longer be providing internet. Or if the clubhouse is open every weekend, before, now the clubhouse will only be open for a certain number of hours, because opening the clubhouse will mean utility bills, right? And also water. And so those operational changes will ensure that expenses are reduced and vacancies are limited. Talking about vacancies, we can also offer concessions so that we can retain our tenants. Number three is the cash flow. The cash flow is the profit remaining after expenses have been deducted from the top line revenue. So think of gross rental income. So this profit is available to return to the investors as the cash flow. So we get this money from the gross rent and we pay all our bills, we pay the debt service, and there's remaining money left. There's always remaining, not always, but if you work with an experienced syndicator, will make sure that due to conservative underwriting, there's always money left. So that money is available to be distributed back to the investors quarterly or monthly. We like to do it quarterly at Westworth Capital. Also provides high risk adjusted returns. I talk about this a lot. I'm going to let Mark talk more about this once we get to that session. Going to segue into the tax advantages. So the risk adjusted returns that we talk about here is the fact that while real estate and stocks provide the same returns, that's around 7%, 6.57%, depending on the economy, you will discover that housing returns are significantly more stable, even in the face of market volatility. Anything can happen tomorrow and Wall Street can decide something can change, and then there's a market volatility, and then the value of your stocks can go down, it can go up. But in multifamily, we're able to predict due to our conservative operations. Federal Reserve Bank of San Francisco, real estate provides the same level of returns, right? So no one ever claims that real estate is going to make you, 20% or 30% annual return. The important thing about real estate is that it is stable and it's predictable. It's got the risk profile of government bonds. However, it produces similar returns as stocks. And the fifth is tax advantages. One of these tax breaks is realized through the magic of depreciation. Think about it. The depreciation is the theoretical loss of value the building experiences over the lifetime of the building. The land does not depreciate, but the improvements on the land, the government allows us to depreciate that. And I'm going to let Mark talk about this in detail. And this depreciation is taken as a write-off. Right? So the reality is that real estate is actually appreciating, but on paper, we get depreciation. So we get a double advantage of an asset that is appreciating and one that is also depreciating on paper. And that's the magic of real estate, and that's why we love it. So what are the characteristics of a successful multifamily syndicator? Number one is relationship. Now that's this. The other time we talked about, what do they do? And I told you that it's not to party. They must be good with relationship building. It's important because it's a relationship-based business. And savvy investors will review a deal, and prior to actually contributing their own hard-earned money, the syndicator, due to the relationship building, can actually get better deals, right, from reviewing a particular deal. There are many times that we've talked to brokers and talking about a particular deal, and the broker will go, you know what? I think I have a deal that might work for you. I think I have a deal that you might like. So through relationship building, you actually get deals that you never expect that can happen. And another thing that you want to look for in a multifamily syndicator is the financial analysis skills. You have to be able to conservatively underwrite and project conservatively. You don't want an aggressive syndicator. And as far as financially analyzing a deal, you want to know what are the NOI, and that's the net operating income. And that's what ultimately determines the value of the asset. So as operators, there are few things that we pay attention to. One of them is the net operating income. The other is the cap rates. The capitalization rates, we don't have control over that. And when we look at deals, it's important to know what the market is paying for that particular asset in that particular area. That's the cap rates. The value of the asset is now determined by the NOI and the cap rate, right? So it's a function of the cap rate and the NOI. The cap rate, we don't have control over. The NOI, we have control over. So the higher the cap rates, the lower the value of the asset. The lower the cap rate, the higher the value of the asset. So we try as much as possible to maintain the value of the assets that we operate. So another point is market knowledge. So market knowledge is important. And that's why even though I live in Pennsylvania now, I will hardly invest in Pennsylvania because I do not know the market. At Westworth Capital, most of our investments are in Texas. That's because I lived in Texas for quite a while and I know the market, and we have boots on the ground still in Texas, and we're well familiar. We have built relationship with property management companies, with brokers, with lenders, and Texas is just a growing market, and that's why we still maintain assets in Texas. So number 4 is ethical character, right? So ethical character is important, and that's because you trust us with your money, and that's a significant amount of money. And before you provide these funds, you want to confirm that I will act in your best interest, right? And so practically speaking, you want to do credit checks, criminal background checks. Also want to get referrals from the investors that this person has worked with in the past. And that's what I expect you to do if you are going to invest with Westworth Capital. And this is a snapshot of the team size. We currently own about 3,400 in multifamily units, and we have raised over $100 million. Actually $130 million in equity. And we have a total asset under management of over $200 million. And the team has a cumulative experience of 50 years doing real estate. And this is a snapshot. Josh is on this call, and that's me right there. Jay is an experienced businessman as well. He started his own retail company operating pharmacies, and he grew it from 0 stores to 11 stores via organic growth and acquisitions. Red used to be a physician. He retired from being a physician to concentrate fully on multifamily real estate investments. And I'm proud to show you our latest acquisition, which is a 320 unit apartment community in the heart of Dallas. This is like 5 minutes to Lawfield if you're driving, right? So it's really in the heart of the city. The purchase price was $27.6 million. It's 320 units. We raised an equity of $10.5 million for this deal. We have a projected hold period of 5 to 7 years, and the projected returns are currently 2.6x of your equity. And that is about 130% return on your money, I think, at the end of the hold period. We have not started because this was an acquisition that we completed in August 31st. So we expect the distributions. So normally when we acquire an asset, we take our time to stabilize the asset. And that means that we will change or, interview the property management company and see if we can retain them or fire them and hire more efficient property management company. We also want to see the books, right? We want to see the books, balance the books. So within the first 6 months, there's always things like tenants sending money to the old owner and us trying to change accounts. So all that is under stabilizing an asset. So we just put a time frame of about 6 months to that. For the El Sol del Lago deal, I'm happy to say that we think that we might start distributions quite sooner rather than later. So the internet rate of return is 20.73 for the 5-year-old period, and that is an annualized average return of 26.4%. These are some of our current investments. There's a Live Oak in Houston, Texas, a 162 unit apartment community. And the Groove at Seabrook, Houston, is 132. Walnut Creek. So you can see that these properties are in Texas. And although we're we're already doing that. We're currently building relationships in Georgia, in Tennessee, and in Nevada. These are growth economies, and that's why we like, Texas so much. Plus, we already understand the market, and we do have. I have personal properties in my portfolio in Texas as well. So I know Texas like the back of my hand, and that's why I continue to focus in Texas. Of course, Texas is one of the fastest growing states in America. So it's important to know that we invest in value add class A, B, or C properties. The El Lago was a C property, but it's located in a class B, C community. The importance of that is when we execute our value add program, what happens is we want to get it to the level of the other apartments so we can charge more. Because ultimately, what drives the value of the asset is how much more we can charge. Because we don't just go on and just charge, hey, your rent has increased from $1,200 to $1,400. Our tenants would just be like, what? Are you crazy? I'm just going to move on down the road, right? So we don't want that. So, and that's part of the value add program that we do. What can we do to justify the increase in rents, right? So we try to upgrade the units, granite countertops, aluminum and stainless steel appliances, wood flooring, and whatnot. So those are the work that need to be done for us to be able to charge more for rent. So I know that much has been made of this, and it's been reported that Donald Trump paid $750 in federal income taxes for certain years. However, the exact details and reasons behind this payment is complex and subject to ongoing debate. Factors such as losses carried forward, deductions, and various strategies can significantly actually, improve an individual's tax return, and it can also impact your tax liability. So as real estate investors, it's important to understand that the tax code allows for various legitimate deductions and strategies that can reduce tax burdens for individuals and businesses. And Mark is going to take the stage, and then we are going to discuss some questions and answers that we have earlier received. Hey, Mark.
Hey, how's it going? Thanks for having me.
Good. So I'm just going to give you a minute just to introduce yourself. I know we saw the slide, but I'd actually like the audience to hear from you.
Cool. My name is Mark Perlberg, CPA. I specialize in advanced tax reduction strategies for affluent real estate investors and entrepreneurs. I have a virtual practice. We have clients across the country, and our mission is to help investors and entrepreneurs achieve financial freedom through tax strategy. And we work with, I would say about close to 98% of our clients are real estate. I've done about 500 or so tax plans for real estate investors. And we work with our clients proactively to reduce their taxes.
Awesome. So right now we have received some questions. First question, Mark. I was expecting to use the K1 depreciation loss, and this is coming from, one of our current investors. I was expecting to use the K1 depreciation loss on my taxes, and I can't currently because I am classified as a passive investor, and becoming a real estate professional is not something of interest currently. Can you explain to our audience why they can't take losses from their real estate investments against W-2 income, and what types of income are eligible for these deductions?
Okay. So basically, the beautiful thing about real estate is even if you're cash flow positive, the depreciation is going to offset that cash flow and create tax losses, or create your income statement for your real estate activity will be negative. And because it has been so easy in the past, and lots of wealthy people were using real estate to eliminate their taxes, they have decided to section off and create different classifications of income. So your real estate income is passive. And if you don't have real estate professional tax status, the losses generated from your K1s will not offset your W-2 income, because those losses are in a separate bucket of passive income, which is separate from your active income, which includes your business income and your W-2 income. But there are exceptions to the rule. One is if you or your spouse has real estate professional tax status and you materially participate in either that rental activity where you're getting the K1, or in a collection of rental activities that could include that K1. Now, that is really the only way for when you're getting K1s from real estate syndications. There's another exception to the rule, which is if you were to have short-term rentals and the average length of stay was 7 days or less, and you materially participated, you could potentially create losses from real estate that you self-managed to offset your W-2 income without real estate professional tax status, but that is not mailbox money. If you're going to manage a short-term rental, that's a whole different asset class, that's a whole different type of activity, and you're going to have to earn your tax savings in that situation to manage it, at least in year one. Uh, Now you can use losses to offset other stuff. So you can have other sources of passive income, passive interest in other businesses. Or if you do not materially participate in a business you own and you own a business that's ran by someone else, you could potentially classify some of your income sources as passive and put it into that bucket that can be offset by the losses of your K1 from your real estate rental activity.
Well said. Well said. So as a follow-up to that, if I participated in a syndication, say about 3 years ago, and then there was an exit, and I initially invested 100,000. Now I'm expected to receive 180,000, which is about 180% return.
Sure.
So will the profit from the sale qualify as uh, a passive? Would that qualify as a passive income? And am I able to use the losses against the passive income?
Yeah, now it's good that you asked this question just afterwards, because when we tell people that these losses from your K1s can't offset your taxes out of your W-2, you might get a little bit upset and you're like, well, why are all these rich people investing in real estate and having all these advantages? It looks like I'm out of the game here. But actually, there's a lot of opportunities here, even if you don't have real estate professional tax status for short-term rentals. And even if it's not reducing your W-2, you still have cash flow that is offset by depreciation. And because these syndications are accelerating the depreciation with cost segregation studies, you're going to get more losses than you can use. So any losses that you get from these real estate investments, I want you guys to go in your prior year returns. If you have any of these, look for form, write this down, 8582. You're going to build up a reserve of losses from all your real estate activities. And that's going to carry forward to when you eventually have a capital gains event. And those losses will be activated. Anything that hasn't been used to offset other profitable, taxable, passive income will be utilized when there's a capital gains event from your real estate, and it will offset that capital gains event. And that could also be if you are investing in other real estate. So if you have a loss from a different real estate property, that'll offset the capital gains on a separate real estate property. It's all gonna be used eventually.
Thanks, Mark. So why real estate? Are there any other asset classes that offer this type of tax advantage?
I mean, yeah, I like a lot of other things as well. I love real estate the most because it's reliable. I like it because you get to use leverage and other people's money to maximize cash flow and access to depreciation and tax deductions. There are incentives like the real estate professional tax status and 1031 exchanges that make this really favorable. But there are other asset classes I like oil and gas, where you can get the intangible drilling cost deduction. That's another way to offset income from your W-2, and you don't do anything at all and gives you passive income. So I like oil and gas. I like the idea of starting side hustles. We're working with clients to build solar panel companies to reduce their taxes, even if they're W-2s, and even equipment leasing companies. So there's lots of other cool stuff out there. But, real estate, I'm a fanatic of it. It's been, historically one of the best ways to build wealth, and the government has lots of tax incentives to encourage it.
Good. And there's another question here. So when it comes to passive real estate investments, would it be more effective to hold them in one's personal name or through an LLC? There's a follow-up to that. And it's what are the advantages and disadvantages of each option?
Right. So from a tax perspective, it really doesn't matter. The only thing the LLC will do is it'll provide some form of asset protection. But when you're a limited partner, you're not really subject to any liabilities. You're limited. So I really wouldn't be so concerned with asset protection. So the LLC, you can do it, and I've seen people recommend it. Whether or not you have an LLC will have no impact on your tax liabilities. So perhaps there's some asset protection opportunities with the LLC, but also you have to now pay to maintain that LLC an annual fee depending on what state that's in.
Okay, so what if in the case of the LLC already owns another business, owns a hair salon, or they're an investor in a medical office? How does that impact the profits from write-off standpoint?
So that absolutely no impact at all. Assuming that LLC is either a single member or an S corp, the treatment of those losses from the real estate would not change if it was owned by an LLC that had other businesses.
And another question. So discussing the difference between investing in real estate syndications and investing in REITs. So I talked to a lot of physicians and they're well familiar with the world of REITs, right? And so the first question that they ask me is, how is this different from a REIT? And so what are the key distinctions and considerations that potential investors should be aware of? And for those in the audience who do not know what a REIT is, so a REIT is a real estate investment trusts. And I'll let Mark expatiate on that.
Yeah. So generally speaking, REITs are corporations. So now REITs, I'm not against REITs, and I've seen them. They can be profitable, just like investing in any corporation and having stock can be profitable. But some of the disadvantages with a corporation structure is you're not going to see the same advantages of depreciation flowing through onto your 1040 if you want to get passive losses. So there's all these usually when we have real estate and we're talking about taxes, we want to be able to flow through all those losses directly on our 1040, even without rep status, so the depreciation can offset other sources of capital gains. And we can build this reserve of depreciation to offset our future cash flow. If you're in this corporate structure, you're going to be paying taxes on your dividends. Your dividends are not going to be sheltered by depreciation. So now there are reasons to investing in REITs, and then there are up REITs, which are really good for deferring cap gains. But generally speaking, if we're talking about an investment trust in a corporate structure, you're not going to see the advantage of paper losses.
So is it true that buying REITs is like buying stocks, right? Which is also subject to
That's correct.
Volatility of any other stock. Yeah. So I think for me, the difference is, investing in REITs and any other stock is the fact that they're actually backed by real assets.
Well, so another very big difference between like buying a REIT and investing in a syndication is the volatility, right, associated with a REIT or any other publicly traded equity, right? Like the public markets are very volatile, and on any given day they move up or down, a percent, 2 or 3. If you're invested similarly, in a real estate syndication, this is a private investment, and the asset values of these private investments they tend to be much stickier, right? And because they're not publicly traded, and so they're not there are not like inflows and outflows on a daily basis that impact that impact like the value of that asset. And so generally speaking, like your investment stays is more secure than if you have, like, let's say $50,000 invested in a REIT, and there's like bad negative news pertaining to that REIT on any particular day. Like you can watch your investment drop 10% potentially, depending on like the quarterly returns.
Yeah, absolutely. You're right. So we're gonna move on to this question, and this question I'm really, really excited about, and that is in the realm of financial investments. What are the advantages of investing in real estate assets as opposed to purchasing and operating a business, right, such as a restaurant? And are there any tax-related benefits to be aware of in this decision-making process?
Yeah. So some of the ones that you've touched on earlier. When you're investing in real estate, you have several advantages. You could take advantage of the appreciation of your land and your property. you have cash flow, you have the tax benefits with depreciation. It's easy to raise capital. You have a replicable model that is proven to build wealth over time. When you invest in multifamily units, you have many sources of income, and you not only do you have profit in the form of cash flow, but the capital gains and the equity you're building are all going to be forms of wealth. Now, I'm not against starting a business, and I would never say that it makes more sense to. I mean, well, I would say for most people, it makes more sense to invest in real estate than start a restaurant. But if your heart's in starting a restaurant, start a restaurant and put your savings into real estate. But the thing that's beautiful about real estate is, now take this with a grain of salt. I'm a real estate CPA who works with real estate investors, but when there's just so many ways to have tax-free income and to reinvest into more and more real estate and compound your wealth. It just opens up a whole world of opportunities that you're not going to see in other industries.
Well said. So now let's take it back to this cost segregation, depreciation, and can you explain the context of cost segregation for real estate investment? How is it done? Can anybody do it? If I wake up in the morning and say that I want to cost segregate or do a cost segregation study on my property, can I do that, or do I need an expert to do that for me? And also, what types of assets do you advise that you can perform the study on? Can you do it on single family homes? I own a single family home that I'm living with my family. Can I do the cost segregation study and take the tax write-off from that?
Cool. So the way the cost segregation study works, now I'm going to start at the base level. When you have real estate, one of your deductions is depreciation, which is to account for the wear and tear of an asset over time. It's all based on the assumption it's going to be losing value. And real estate depreciates over 27.5 or 39 years, which is a long time to write off that purchase of the real estate. When we do a cost segregation study, we evaluate this real estate and we find different items in the real estate that will depreciate faster and give you faster deductions to create tax losses. We may find those deductions to be cabinetry, ceilings, fans, window curtains, driveways, carpet, refrigerators. These are all things that will be useless and will wear out faster than the main structural components of the real estate. And this gives us massive deductions. Then there's something called bonus depreciation that allows us, once we've assigned a value to these items and we can write them off, we can write off 80% of any of those items identified in this cost segregation study that finds these items that depreciate faster within the real estate and breaks them out. Now, to do this, it takes a good amount of effort and expertise, and you will be able to, you're going to basically, the way that is done is they will use a job costing software, and that software is used it's called the RS Means database, and it is used to assign and quote for different construction projects and assess the cost of the labor and the materials. And based on the features that you've evaluated and the specs of the property and square footage, you will run it through an algorithm, enter different information, and you will determine the fair market value of each of these items, whether it be the structure, the driveway, the balcony, the deck, the patio, the pool, et cetera, et cetera. And that allows you to identify what you can depreciate faster. This is, we have an in-house cost segregation engineer. It takes a long time for him to be independent in doing this. And this is not something you would DIY. Not only that, but you may not even know if it makes sense. So you got to work with your tax advisor before investing in an engineer to do a cost segregation study, because anyone will sell you a cost seg study that offers it, but you need a tax advisor who understands the concept to make sure that it'll actually reduce your taxes. And yes, we have done cost segs on single family homes that are rentals. Well, we just want to make sure is that whatever it costs to do the cost segregation study, we can create significant tax savings to justify that investment.
So can I do that cost segregation on a home that I don't rent? I just live in it? No.
No, because it's not a business asset. It doesn't get any depreciation deduction at all.
Good. All right. So let us talk about the tax liability at the point of sale, right? Definitely some tax, and you may have answered this earlier. Just want to be clear for the benefit of the audience. So at the point of sale, what are the other strategies that can be done in order to, because I've heard people throw around 1031 exchange, for example. So what are the strategies that you will typically recommend to your clients when they are selling a property and they're trying to avoid taxes?
Yeah, so we have a lot of things that we can do. Now, the most common ones you'll hear, and which we do often, are 1031 exchanges. That's where you identify a property to replace the one that you're selling. It has to be of equal or greater value, and it just has to be any form of real estate. So you can exchange a single family for a multifamily for a farm or a hotel. It just has to be real estate. And so when we've done that oftentimes, and that'll defer the capital gains indefinitely. A lot of times we have a 1031 that fails, or they can't find a replacement, or maybe they do have a replacement, but it wasn't done through a 1031. In that case, we just do a cost segregation study on another property, or maybe we invest in a syndication such as your own, and they run a cost seg, and those passive losses can offset the capital gains as well. Some other things that we consider are qualified opportunity zones that'll defer the gain. And another thing that we do that's a little bit, some other ideas are taking your proceeds and just redeploying it back in your business if you own other businesses. And then those deductions will offset the capital gains. And then finally, we'll even consider investing in oil and gas, where you write off up to 90 cents per dollar of your cash investment, and that'll reduce your income being taxed at your ordinary rate, which will overall reduce your taxes and any additional tax that could have been generated from your capital gains. Got a couple of other things we do, but those are the ones that we're most likely to discuss.
I am going to move forward to the chat box. It looks like we've got some questions. So I'm going to try to go through them as fast as I can.
Now, also, a lot of times we get clients who are selling properties for capital gain, but we'll oftentimes realize that there's either no or minimal taxes because they have losses from their other properties that have been accumulating over the years.
Okay. So let's I'm going to read out these questions. And okay, so there's one. I'm getting questions directly related to syndication. Number one is talk about deals you have done and through full cycle of the deal. And so, and this was the one that we did at Westworth. It's a deal in Houston that we refinanced Live Oak, right, during the COVID. So you notice that during the COVID, there's a lot of properties for sale on the market. Interest rates were at all-time low, and it was an opportunity for us to exit some of the properties. We felt like the properties were cash flowing really good. And so we provided another exit, which was to refinance and give the money back to the investors. So the investors actually got bulk of their money back when we refinanced during COVID. So that's an exit. So there, of course, we could have decided to sell the property, but it was really good performing asset, and we wanted to hold on to it. And that is something that the investors vote on whenever there's an opportunity for an exit. So we advise investors, hey, we can refinance this deal, or we can sell it. If we sell it, this is what your return is going to look like. If we refinance it, this is what the return is going to look like. So the one deal I'm talking about, which is the Live Oak, was a refinance from a 6% interest rate to 3.1% interest rate. And that was a good exit. And number two is you're operating vertically integrated. What areas do you outsource? Vertically integrated. Oh, okay. I may have misunderstood that question. So no, we're not vertically integrated. I think I mentioned this earlier. We outsource different things, right? We outsource the property management company, and we outsource tax functions as well. How are you researching the areas you source properties? I love this question. So different ways. First of all, you have to have boots on the ground wherever we're investing in. For now, it is Texas. We are already developing teams in Georgia as well as Tennessee. But when we are evaluating the property and we want to research the area, there are different tools that we use. Number one is BLS.gov. We want to be sure that we know the employment trends in that area, right? So we want to be sure that we know that jobs are growing, know that employers are moving into that area. So we use BLS.gov a lot. Another tool that we use is bestneighborhoods.gov. In fact, as a matter of criteria, we will not invest in any area that once we put the address on bestneighborhoods.gov and then we zoom in on the particular points on the map, and if it is red or deep orange, we know that that area we will not invest in because that's like a low D class neighborhood. So bestneighborhoods.org is a really great tool that we use. We also use word population reviews. And after all that, because we use all this tool to sift out, okay, what are we going to be investing in as far as the BLS.gov job growth and also the population, census.gov, quick facts. In census, we want to know over the past 10 years, as the population in this particular area increased or decreased. Is it increasing or is it decreasing? And the areas that we invest in, we see that the population growth is always positive, right? Currently, Cincinnati, I was looking at a deal in Cincinnati, I saw -2. I think negative 0.2 thereabout. And right off the bat, I was just like, no, we are not investing here. So we want to actually see the pattern of growth and also business expansion news. So we subscribe to business expansion news. That's where we get news of businesses that are moving into a particular area, because that's another way of getting into a particular area for cheap. So let's say that, people generate, the news is not out there yet that Amazon or Tesla is moving to Harrisburg, Pennsylvania, for example, right? And we watch the business expansion news. We see how many jobs is this new company going to create. This is an area that is in the path of growth and what have you. So that's how we do research in the areas. And also the average cap rates. So you're looking for an area that the average cap rate is between 6%, from 4% to 6%. If you go lower, you're toying with cash flow, with investors' cash flow. Those are high value areas that you will not necessarily make a return on your investment if you invest in, such as California. Of course, California is a blue state. We wouldn't even touch California with a 10-foot pole at this point. But California is an example of San Francisco, right? Really low cap rates, 2%, 1%. You don't want to invest in that because you actually want a return for your money. At the same time, you don't want to go investing in a war zone, right? You don't want to go invest in Southside Chicago. And that's why they are high cap rates, right? They make returns, the rent and everything. The returns is a lot, but it's riskier, right? So we like to be in the middle. We like to be in the average areas that we know that we can get good return on our investment. What area in Texas are you looking at? Houston, Tomball. So the current investment that we have open right now is in Tomball, Texas. I am going to get there. I think it's on the next slide. It's really exciting. It's 228 unit Class A community that we are buying for $30.2 million. Stay with me for that, but we'll get there shortly. So we like to invest in Texas, in Houston, in Dallas. There's Lubbock. Lubbock is really is another great area. Waco. Essentially, we're looking at primary and secondary markets. So we just like the market because it's a growth market. We like to invest in the red states for obvious reasons, right? They are business friendly, they are landlord friendly, and that's why we continue to. So what class properties do you buy and what cap rates do you seek? Yeah, I think I just answered this question. So generally seek between 4 and 6, 6.5. We like to stay in that area. Explain your underwriting process. Good question. So how do we underwrite our deals? First of all, we want to know the average cap rates in the area. And what are we getting? We pull the CoStar report. So we subscribe to CoStar. CoStar is the largest data aggregation company in the world. So when we pull the CoStar report, we want to know the properties that have traded recently, how much did they sell for? What's the average cap rates after those sales? Once we get that, and then we get the guidance, the pricing guidance, and then we put them in our model. So we have a model. We have different types of models that we use. We have the ones that we can actually do more or less like a back of the envelope underwriting, right? So we have different models. The extent now, when we drill down to a property that we actually want to expand underwriting on, and then that's when we actually use the main model. We enter the purchase price, we enter the debt. At that point, we would have received quotes from lenders based on the current interest rates. However, you always want to go about 200 basis points above you use as interest rates when you're underwriting the debt, because between now that you've just been quoted with a 6.5 interest rate, by the time you close or by the time you lock in the interest rates, keep in mind we are raising equity. So there has to be the evidence. There has to be the proof of funds, which is after we complete or get to a certain level in our equity raise, then we go back to the lender and be like, hey, we have this money in our account. Can we lock the interest rate? So all numbers are still wavy up until that point. So we like to generally underwrite with about 200 basis point above the current quoted interest rates. So when we get that, so another point that we look at is we run a 10-year model. We know that we're holding the asset for 5 years, but we try to run a 10-year model. And if the ongoing cap rate is, say, 4.75, we will underwrite at a lower valuation. That is, we will underwrite at, say, 5.5. We are also underwriting conservatively for exits because we do not know what cap rates will do in the future. So what we are doing at that point is saying after 5 years, you cannot guarantee that this area will continue to grow. Of course, it's just basic common sense, right? So the current cap rate is 4.75. You know that year over year, cap rates have either remained stable or they've expanded or constricted, whatever the pattern is. And then what we do is we generally now conservatively say, okay, it's 4.75 today. Why don't we just leave it at 4.75 for 5 years to come, right? It's a growing market. Technically, it should actually reduce, right? Because the value would have appreciated, and also you're getting rent increase, which will increase the net operating income, which ultimately will increase the value of the asset. But you want to keep things as is at this point. So that's one of the ways that we conservatively underwrite. We do not project too much growth. We hope and not hope, because we are underwriting conservatively. And then we know that obviously underwriting conservatively, you're not going to go wrong. So as an investor, we will promise you less and we will deliver more. That's just the model that we take. Let me think. Another point that we tend to look at when we are underwriting is, are there any value add opportunities? Because that's really important. If we are buying a Class C asset, is there anything we can do to increase the value? If we see something, you say, oh, we're touring the property and we see that it's got a large premise, the premises is so large, maybe we can actually do covered parking and have people pay $100 a month or $70 a month for it. So that is adding value, because that is going to go into the gross rental income. Remember when I said earlier, the only thing that matters in this world, in real estate multifamily, is the income. Nothing else matters. Unlike single family homes, your 1 unit to your 4 units. How much did my neighbor's house sell for? That's how much my house is worth. But we are able to do forced appreciation for properties in the multifamily sector. It doesn't matter what the next 10 unit building sells for. The 10 unit apartment next door might have sold for $1 million. My own 10 unit building, I can sell it for 15 by forced appreciation, because A tenant is going to come here, is going to see the granite countertop, is going to see the aluminum appliances, and is going to go there and is going to see the carpet and is going to see the white outdated appliances. A tenant is willing to pay $150 more for my apartment to stay rather than that one down the road, right? So, and of course, it then affects the property value, and then my property value goes on. That means I have forced the appreciation. What other things are we looking for? Can we start charging for internet? So another thing is the internet, right? The internet surcharge. So we go into contract with, say, Xfinity or with AT&T, and then the wholesale internet for us. Let's say the market internet rate is $50 a unit. AT&T comes to us, or we go to AT&T. Hey, we have 300 units apartment community that we want to implement internet. Are you going to give us at $40 a unit, or you don't have our business? AT&T will be like, oh yeah, we'll do it. So AT&T gives us $40. We are not cheating the tenants because they're still paying $50, but we are increasing our NOI because we're paying AT&T $40 per unit. So those are some of the things: paid parking, reserve parking, dog park. So that's how we underwrite. We want to make sure that value add opportunity is there. And one thing I've noticed is a lot of investors, they can be emotionally attached to the property, which can be a good thing and it can also be a bad thing. So I try to educate investors that don't be too emotionally attached to the property. And when I say emotionally attached, they want to be on the golf course and be like, hey, I invested in that property. That's good. That is a good thing. But how much is the property making you? That is the more important question. And you will see that some of these properties that we're talking about, the Class B, the Class C assets, they're actually cash cow, even though they are not as pretty as the Class A assets. Class A assets are stable, and that's why the institutional investors invest in it, because they want their money where it is. Wealth preservation. We also invest in Class A properties, but before we invest in Class A properties, we want to be sure that at least the investor is getting a reasonable amount of return, at least 6%. Another question here, underwriting process. So the minimum investment generally for every deal is $50,000. A lot of people do multiple of that, but generally it's the minimum of $50,000. So question for you, Mark. I move out of my primary residence, and turn it into a rental. Can I start deducting depreciation from that point on when it becomes a rental property?
Yeah, as soon as you move out, it becomes a business asset. You then put it on your tax return as that business asset, and it begins to depreciate.
Perfect. So, and can it depreciate it for the full 27 and a half years?
Yes.
Good. I think we've just gone through all the questions that we have here. So I'm going to go over to the deal presentation. Please let me know if you cannot see my screen at this point. Can you see it?
Yes.
Okay. So everyone sees my screen. We're good? Okay, good. So I'm presenting you the Cape. It's a 228 unit apartment community that was built in 2006. This is in Tomball, in a very great neighborhood. We'll still get to that in Houston. This property, I have another chat. You're welcome, Cody. So this property is already under contract. That is, we have signed the letter of intent. We have received go ahead for this property, and we have signed the purchase and sales agreement. Oh, it's also important to know that this is the broker's offering memorandum. Before we actually offer the deal and start to raise capital for this deal, we will present our own offering memorandum, which will have our own numbers, right? Our own projections. So this is just a snapshot. And the reason that we're holding off on the offering memorandum from Westworth Capital is because we want to complete due diligence first and then start the equity raise. So this is investment highlights. This is what the swimming pool looks like. This is a really beautiful property. And you can see it, and it's attractive, and that's why Class A assets are like the core investments. The executive summary, it's 228 units. It was built in 2006. The current occupancy is 94%. And what that means is, out of 28 units, that's good occupancy. And this is the current rental for 1 bedroom and also 2 bedrooms. There's 132 units, 1 bedroom. 2 bedrooms is a 96 unit. So there's extensive value add opportunity in over 62% of the units. Now, LTOs, lead trade out, the growth, there's been a growth of 6.8% on last lease trade outs. So that is a tenant moves out, and then you put in another tenant with increased rent. So there has been 6.8% on the last 25 leases. So what are the value add opportunities that we're talking about? Currently, there are 11 units with classic finishes. And when we talk about classic, this is the one. And this classic is even like the upgraded units for other multifamily classes like the class B and the class C, right? So that's what the classic unit in this apartment looks like, full unit. And there's the granite unit and the quartz unit. So we see different grades of improvement in this property, which is really attractive because it attracts different tastes from different tenants, right? So different tenants have different tastes, so they can opt for one against the other, and that's just the value add opportunity that's available. And this property's got a strong market performance. You see how the occupancy is trending. The lease trade outs and the property performance, again, as earlier mentioned, 6.8 and 2.8 rent growth. That's the demographics. So within a mile radius of this asset, the average household income is 123,000. So this is not a property located in a low income neighborhood, right? This is a high income neighborhood asset that's located in a high income neighborhood. And when we look at the single family homes that are for sale in that area, we are seeing homes at 585,000. 849,000, 474,000. And the school district are also rated B+, A and B+. So you know what you're getting. This is what it looks like, is well maintained. And this is the CapEx budget that was already spent by the current owner. So the current owner already spent 2.5 million in maintaining this asset. And what was one thing about real estate? Location is really important. And we're glad that this asset is actually located in a really, really amazing neighborhood with different stores and schools nearby. There we see big lots. We see Planet Fitness, Hobby Lobby. There's a lot. So you can imagine this area, right? It's not, you already know what kind of area this is when you see Target and you see Starbucks, right? So there are different employers in the area. There's the Noble Energy, BJ Services, Tomo Business and Technology Park. So I'm just going to breeze through this real quick in the interest of time. The airport. Major healthcare employers in this area is Tomball Regional Medical Center and Houston Methodist Willowbrook Hospital. As far as education, there is a Lone Star College system in the area. Retail and entertainment, it's Marshalls. So it's a typical American city, not, typical American suburb, right? High income earning class A suburb. And it's got retail and entertainment also nearby. And that's the property right there in the middle. Right, there's the Smoothie King across the street from it. There's the IHOP, and that's the Ford. I think you get a sense of the location just by looking at the area view of the asset. And property information. Let's just get through the property information. And keep in mind, guys, you will receive a proper offering memorandum for this deal. This is just a snapshot just to show you what's coming. We already have this property under contract. And if you're looking to invest capital, you should definitely be looking at this after you, of course, receive the official offering memorandum and you take a look at the numbers. So the property details, there's the manager, the full-time manager. So this property currently has 6 full-time employees. 1 manager, 1 assistant manager, 1 leasing consultant, 1 maintenance supervisor, 1 porter, and the make ready. These are the community amenities. So it's got a little clubhouse. This is the pool area. And there's the reserved parking and also covered garage parking. And that's the fitness center. It's got a dog wash station. And it's got the pergola on the outside and the volleyball court, dog park. And it's the mail center, kind of like the Amazon locker room. This is what the interior looks like. This is the quartz upgrade. I think that's the highest of the upgrades that's currently in the property. So there's opportunity in 62% of the units to do this and charge more. Currently, this is the unit mix. So the property is currently getting an average of $1,278 rent. And we see how that varies from unit to unit, depending on the square footage. The IS is making 1569 in rent, and that is the 2-bed, 2-bathroom. It's a floor plans. There's an area shot of the property. So apart from the pool, it's got this lake as well, which is really pretty. This is the pro forma financial analysis. Now, in our underwriting, we don't pay attention to this. We only pay attention to the actuals, the T12. That's what we take a look at. Also, the rent roll. We have our own model, so we never pay attention to the broker's estimates. And these are their assumptions as well. So you see where CAPE is on the scale of things as far as rent roll is concerned. You see how it stacks up against the other Class A properties in the area. It's the one charging the least. And remember when I said that in underwriting, you want to be sure that the rents are below market. So without even doing anything, without any effort, you want to be able to increase rent upon lease trade outs. And that's what they've been able to do up until this point. And we are going to take over and actually make it more efficient. The CAPE is actually charging the least in rents in that particular area. And this is how far the CAPE is from the other assets. Right. So there are no competing assets in the immediate vicinity of this property. Right. You would have to go. I think this, just off the top of my head, I'm thinking it'll be over a mile radius. So there's that element of scarcity. And that concludes the preview of the CAPE. Watch out for this. And I'm gonna go back to right. So I think we're almost done here. I presented you the deal. That's the CAPE. And we have a Q&A. So why choose our multifamily real estate syndication? Number one is the track record, right? We're not, I always say this, I'm almost oversaying it. Always saying that we're not gurus, right? And what's the meaning of that? It's new gurus, right? So actually, I'm not against someone being new into real estate syndication. You want more people to join you in doing this, right? But at the same time, what you should ask any new syndicator is who is on their team. So it's really important to for the syndicator to. Can you guys hear me okay? Because I'm getting a feedback.
We can hear you. We can hear you, but we can hear I hear the echo, but we can hear you.
Yeah, I hear that too. Okay. I'm going to try to stay back away from the microphone because it looks like it's my earphones. Okay, so really, if you are looking to invest in syndication, you should be asking questions, right? If the person is a new syndicator, who else is on their team? Because there's really there's nothing wrong with doing something for the first time. You always want to encourage people to do things for the first time, but you want to know what's the team, who's on the team, what's the experience on the team, right? So that's always important. At Westworth Capital, we leverage experience. We leverage technical experience, tax experience, accounting experience, property management experience, loan financing experience, equity financing, and also family offices. So we leverage all this to make sure that our deals are successful. Again, I've walked you through the track record of Westworth Capital. And another piece is the risk management. And this is one of the reasons why you should choose our real estate syndication, is the risk management. Because we do comprehensive due diligence, right? We check We actually physically go into every unit of the property. It doesn't matter if it's 1,000 units property. We will walk every unit of the property to make sure there are no surprises. And while we're doing that, we actually have engineers on ground, and also the engineers, the contractors, and we are constantly estimating how this needs to be done. How much is it? How much is it? So that gives us leverage in negotiating with the seller. So due diligence and property analysis, we are really thorough, and we keep asset management in-house for effective investor communication. If Mrs. Brito comes to me and asks me what's the state of she's an investor in one of our deals, what's the state of this property, I am able to give a first-hand information. I'm not going to tell her like, hey, would you give me till tomorrow morning for me to get back to you? Because I know everything that's going on. I know everything that's going on with the property, because we keep the assets management in-house. Some people outsource it, which, by the way, eats into the profit as well, right? So we get on the phone call with the property management company. We review every little detail of the property, including lease, upcoming leases, and upcoming lease trade outs, and contracts. And we actually, and talking about actually reviewing everything. So we have in writing with our property management companies that they are not to spend any money that is over $3,000 without our consent. So we have to have our approval before they make any repairs that is over $3,000. So the risk management piece, you don't have to worry about that. Now, the market knowledge, which I mentioned earlier, is that we have boots on the ground in everywhere we invest. And at any point in time for any of our properties, there's someone that can get there within 5 minutes. There's no need to book a plane ticket, and we are always there. So we know the area, right? And we perform in-depth research into the market. Even new markets, we try to take a while before we start to get into new areas. And of course, our criteria are really clear. Areas of positive migration, areas that favor businesses. I'm not going to invest in New York. It takes 1 year, excuse my language, 2 years to do eviction, right? That's not going to happen. In Dallas, you don't pay my rent, you're out by the next month. 3 months tops, right? So that's why we invest in Texas. Now, the investor returns. You already know about the hold period. It's typically 3 to 7 years. And we're always shooting for at least the investor has to double their money. There are investments that overperform these projections, but we're just looking at Class A properties because they are low cap rates. That is low, after paying the debt and all of that, because they're high value properties. Now the returns might not be as robust as a Class B or a Class C, but with the value add component, an experienced investor is able to deliver such similar returns to investors. So the internal rate of return is between 17 to 22%. And this internet rate of return topic is a little, some people struggle with understanding it. And the easiest way I try to put it is, if you were to invest $10,000 in a deal, that will return $20,000 in 7 years. And another deal that will return $15,000 in 4 years. Which one will you invest in? Of course, I don't mind the $15,000 to take back in 3 years, because time value of money. There's the time value of money. So that's the IRR. So within the hold period, that is the internal rate of return that we're looking at. The quarterly distributions, typically after the 6 months of takeover, 6 year. You don't want to get your money back after 6 years. Yeah, so after 6 months typically, and that's what we say. We usually try to shoot for sooner. And so what are the steps in investing in and owning your own multifamily real estate and being part of a syndication? It's pretty straightforward. It's really, really straightforward. First, we start with a phone call. It's a discovery phone call, and you meet with Westworth and the co-sponsors, and we do a little introduction. And then we schedule a Zoom meeting where we actually deep dive into our deal, and then in person. We also, if you're nearby, we prefer to meet over coffee, right, and continue to chat and develop a rapport. Then we present you the investment opportunity. You review a current opportunity to join the investor webinar to learn more, and you place a non-binding soft commitment, right? So when you register at our portal, you are not, even though you say, hey, I'm going to invest $100,000. It's non-binding, right? You can change your mind tomorrow, as long as you have not actually signed the private placement memorandum, which is the fourth. Then you review the PPM, and then sign the subscription documents, and then you wire the funds after, and then sit back and enjoy the returns on your investment. These are ways to get in touch with me, and get in touch with me via email. That's my phone number. Or you can visit the westworthcapital.com website. It's got more information. And also, I'm on LinkedIn. I'll be looking forward to meeting you all. Thank you. Thank you so much for joining the session. So does anyone have any spot questions? Any spot questions? Okay.
Dami, you've got a question there in the chat.
All right. Okay.
Hey, Demi, I have
Okay.
I have to head out early. If you guys want to reach out to me, email info
Yeah.
at markperlbergcpa.com if you want to learn any more and join our mailing list.
Mark hosts podcasts every week, so please go over and look. And you can also reach out to me if you need his information. But if you look in the past emails that I sent to you, especially the one with the invitation, you will see Mark's information right there. And I'll also be sending it over after this call.
Wonderful. Thanks a lot, you guys. Great talking to you, and have a great weekend.
Thanks, Mark. I'll catch up with you later. Yeah.
Take care.
So there's a question here. How do you get compensated? So the fee structure is really simple. There are only two fees that we take. It's the 2% acquisition fees. That's after the acquisition. We take 2% acquisition fees, and that's 2% of the purchase price. And also 2% assets management fees, which is 2% of the gross rental income every month. Now, upon exit, that is actually what we work for. That's where we actually get really compensated. There are different structures to that. Some structures will have us pay the passive investors first before we take any money. Some structures, right off the bat, there's an equity split. So we split the profit either 20/80 or 25/75, depending on the structure of the deal. So that's how we get compensated. Thank you so much for spending the evening with me. I really appreciate your time, and I look forward to talking to you and doing business with you all.
Thank you.
Thank you.
Well, Dami.
Thank you, Demi.
Yep.